Hello, welcome back to Sabi Market Channel. Thank you to all of our viewers. Thank you to our subscribers. And if you're yet to subscribe, please, this is the best time to do so. And you never get it wrong subscribing to our channel. And like I mentioned in my last video, that it actually costs you nothing to subscribe. You are charged zero currency for subscribing to our channel, and you are assured of getting quality and valuable insight from this channel. Just stay tuned. All right, so here we are here again for dispensation of value, form of insight, and we are looking at again Lafarge Africa Plc. So like I mentioned in my last video, I said this has already become like a series, but yeah, this is the last video I'm going to be reviewing on Lafarge Africa Plc. So in my next video we'll be reviewing another company, another organization. So this will be my last video on Lafarge Africa Plc. So I think this is the first company I'm giving a full overview of, at least about 7 of their metrics, or so 6 or 7 of their financial metrics, and that gives a clear picture. If you see all of these videos, you get a picture of how well they are performing or how terrible they are performing, and that will depend on your expectations though. So I gave my own comments as regarding their performance in my last video, so I don't know what you think. You might want to look that out and also tell me what you think. I'd like to know. Today we'll be looking at Lafarge Africa PLC's debt to equity ratio for 2023. So the debt to equity ratio is a financial metric that assesses a company's capital structure by comparing its total debt to its total shareholders' equity. So this ratio provides insight into a company's use of debt financing, its ability to meet financial obligations, and its overall financial health. So this is a very crucial metric to review when you are running a company, when you are trying to invest in a company, or you are a manager, or whoever you are that you're interested in business and you want to know, what's the performance like, what's the financial performance like, what's the what are the financial obligations of this company, what is the state of their financial health, and all of that. So this is one metric to look at. All right, so to obtain this value, you just divide the total debt by the total shareholders equity, and you might want to multiply by 100 to get the actual percentage. So for the interpretation of these values, so here you can see 36% and 64%, and then by the side the legend is telling us that the lighter blue, sky blue, is indicative of the equity, and the this royal blue, the darker blue is indicative of the debts. So we can see here that the darker blue is reflecting 36% and sky blue is representing 64%. So it's saying that this company is run by 64% equity, and they are running on 34% debt, and 64% is being run by 64% equity and 34% debt. So and the ratio for this is 0.57. So a debt to equity ratio. So if you divide both of these, you get the debt to equity ratio, and that gives us 0.57, the 2 decimal place. And so a low debt to equity ratio, anything less than 0.5 is considered a low debt to equity ratio. Anything 0.5 to 1.5 is considered a stable debt to equity ratio, and anything above 1.5 is considered a high debt to equity ratio. So I'm going to give an interpretation of these benchmarks and their implications to an organization. So so a low debt to equity ratio, I've given the range, actually indicates that a company is using less debt financing and they are relying more on equity. So this can suggest a more conservative approach to financing and a lower risk of default, right? There are some companies that have, for instance, 64% debt and 36% equity. Such company will have a high debt to equity ratio, and I'll give you the implications of that as we move on in the video. So a high debt to equity ratio indicates that a company is using more debt financing and relying less on equity. This can suggest a more aggressive approach to financing and a higher risk of default. So if this 64% was debt and this 36% was equity, it's actually indicative that they are adopting a more aggressive approach to financing, and there is a higher risk of default for the company. So, like I will always do, I like to highlight the advantages and the limitations of a particular metric, and debt to equity ratio is no exception. So this metric helps investors, and this is in terms of advantages now. It helps investors to understand, as well as analysts, to understand a company's capital structure and its reliance on debt financing. So it just gives you a brief overview. Okay, this is how these people are operating. They are high on debt, or they are high on equity, or it just gives you a picture of their financial operations in a glimpse. So, and then it also provides insight into a company's financial risk. How risky are they? What is the position of risk when it comes to their finance? Where do they stand? So it's to provide the insights to the company's financial risk, including their ability to meet their debt obligations and their vulnerability to interest rate changes. So when a company is operating highly on debt, they are susceptible and they are vulnerable to interest rate change. So for instance, we have in Nigeria now where interest rate is skyrocketing. Any company that is running much of its operation on debt now is at a disadvantage, because that's in no way favorable to them. So also this ratio allows for comparison across different companies and industries, enabling investors and analysts to evaluate a company's financial health relative to their peers. So we can see a company that has 0.5 debt to equity ratio, and we see another one that has 1.5, and then we can easily tell what's happening in those companies, and then that can inform our business or investment decisions. So this, moving to their limitations, the ratio does not consider the quality of a company's assets, and that can impact the ability to meet debt obligations. And it does not also account for interest rates. So it does not take interest rates into account, and that can significantly impact a company's debt servicing costs and financial health. It also can be manipulated, can be influenced by accounting decisions such as classification or debt as short-term or long-term. So I'll be diving straight, although there are some best practices that I would have loved to mention. I think I should just also just pick that up. So I've mentioned some of them before, like it's just still the same in my last video, like I said. So we can compare industry averages, which is benchmarking. Benchmark gives us a picture, and you can just have an overview at the spots and say, oh, this company is better to invest in this company more because they have the tendency of servicing their debt and meeting their obligation, and that can inform your decision instead of throwing your money where it all gets lost. So like I always advise, use the debt to equity ratio in conjunction with other financial metrics. So you can consider using the debt to equity ratio along other financial metrics such as interest coverage ratio and current ratio. So this video doesn't cover all those, but then you can just do your own little research. Yeah, so all right, so I'll just throw a before I end the video, I just want to give more of an overview as to helping you understand what the metric says. So like I said before, low debt to equity ratio and it is anything less than 0.5. Now we have Lafarge at 0.57, right? Now when the debt to equity ratio is less than 0.5, it shows that the company is relying more on equity financing than debt, indicating that they adopt a conservative approach to financing, right? And a low debt to equity ratio suggests lower financial risk as the company has less debt to service. Also, a company with a low debt to equity ratio may have more flexibility to take on debt in the future to finance growth initiatives. So these are just kind of pros attached to having a low debt to equity ratio or investing in a company with a low debt to equity ratio. So then we have the moderate debt to equity ratio, and this is the range between which Lafarge Africa Plc falls. So, and this is 0.5 to 1.5. Lafarge is 0.57. So this shows a balanced financing approach. So this, you see why I said in my last video that I am kind of impressed by their financial performance. So it shows a balanced financing approach. So this reflects that the company is using a balanced mix of debt and equity financing, indicating a moderate approach to their finance, right? Okay, so a moderate debt to equity ratio also suggests that the company has adequate financial flexibility to meet its obligation and invest in growth initiative. Then industry norms, a debt to equity ratio within this range may be considered normal for the industry, indicating that the company is in line with its peers. So we can see here that Lafarge is doing well. Yeah, in a nutshell, with regards to debt to equity, right? Because it doesn't cover for all other metrics. Then we move to the high debt to equity ratio, which is anything greater than 1.5. So like I've touched this before in the earlier part of the video, that the company is relying heavily on debt financing, indicating aggressive approach to growth. Then a high debt to equity ratio suggests higher financial risk as the company has more debt to service and may be vulnerable to interest rate changes or economic downturn. So the vulnerability is intense. Then also potential for financial distress. Any organization with a high debt to equity ratio may be at risk of financial distress if it is unable to meet its debt obligations or if interest rates rise significantly. So I don't think, with all this, I don't think that's a very good approach to adopt, and because it exposes you to too high of a risk. But then some companies are able to manage it well. Yeah, but I think it's better to stay moderate. I don't want to stay safe, but then to stay moderate. All right, that will be all for this video. Thank you for staying to the end. So we see here that the debt to equity ratio, like I mentioned, is 0.57. Position them at a moderate rate, which is a good place to be. And then we see the percentage of debt they are running on and the percentage of equity that is financing the company. So the company's operation is financed by 64% of equity and 36% of debt. Yeah, thank you so much for staying to the end of the video. As always, I'm open to your questions, your comments, and your opinions. Please, I would like to know what you think. Just drop them in the comment section, and that will be all. Thank you so much for staying to the end. I'll see you in my next video. Bye bye.